Welcome to the Trading Zone on the Trader Hub, sponsored by the MIAX. I'm Joe Teague, portfolio manager at Equity Armor Investments, and with me is
Brian Stutland, also a portfolio manager at Equity Armor Investments. How you guys doing?
Yeah, it's good to be here. Brian, missed you last week. I hope you're feeling a lot better. But yeah, last week we had a really good show. We talked about a whole bunch of reasons why it might look like the market has hit a top or is about to enter into a recession. We did enter in the big caveat, though, of course, that government spending remains sky high, and that might help the market just stabilize it, or the economy essentially stabilize itself, even though the government's been spending like we've been in a recession since COVID, hasn't really stopped it. So maybe that's been fueling the economy to keep on going. We'll see if that continues to be the case. The factors driving a recession are still there, though, and the risks are certainly still there, Brian.
They really are, and there's really a lot to digest about the market. But Joe, I'm really excited about what's to come here as we are one day upon election day here in the U.S. and obviously big outcomes, and also the Federal Reserve rate decision later this week. So quite the week on tap here. Be kind of interesting to see how things shake out, and I think we have a lot to talk about.
Yeah, it is really exciting from a trading perspective about the outcome. The market certainly is pricing in a big move, and I want to talk about that a lot in our show today, Brian. We're talking about how the market's been higher the past couple of months and volatility has been up. I think that could be a big clue for the market. I think people should pay attention to that.
Yeah. Well, I'm Brian Stutland here, Equity Armor Investments, with my colleague here, Joe Teague, on the show, The Trading Zone. We're about to get started here. We got a lot on tap. Joe, what do you got for us?
Yeah, obviously the election is going to take place tomorrow. Mercifully for a swing state resident, it's going to be over soon. All the political ads will be done. My text messages will be gone. All the phone calls will be over. We're going to see some volatility as a trader. That's really exciting. From thinking back in previous elections, 2016, big move overnight. The market reversed course afterwards. I think Brexit was very similar too. Surprise result, big move overnight, market reversing course. So I think I'll expecting the same, a big move, and then I think the market will kind of fade whichever direction we go.
I think that's right. I do remember the 2016 move very distinctly. It was quite the volatile move overnight. VIX futures traded significantly higher. And we might get something like that. So I'll be on my toes overnight and be ready to take action on this. But I think later on in the show, we have a trade that makes it maybe a little bit easier to play long the market in a different way and not have to be up overnight, but still get upside participation. So we'll get into that later.
Absolutely. Yes, we have the election. We also have a Fed meeting, Brian. The market's pricing in 25 basis points. There's a lot going on in the world. I don't think the Fed is going to surprise with a 50 basis point cut or a no cut policies statement. So I think it's 25 basis points. They're just going to move it on to the next meeting because they don't want to add any more uncertainty to this already volatile week.
And I think, kind of obviously this is in the forefront with the backseat of earnings kind of sits back and sits there. Obviously, Berkshire Hathaway came out with earnings, building huge cash piles right now, dumping stock in Apple through the month of October, not buying back their stock at all, actually, for the entire month of October, which was quite interesting. And then you had Jeff Bezos selling tons of shares of his own stock. So big name insiders lightening the load here. So, this could be a catalyst that's a turning point for the markets.
Yeah, they're adding cash. Valuations are high. There's a lot of uncertainty out there. They're going to have plenty of bullets to fire if the market pulls back. So that could be exactly what they're thinking. And finally, there is still the geopolitical concerns. We're talking a lot about what's going on in our country tomorrow, but there still is the concerns around the world. This still could turn into something which we don't want to see, something which could spiral oil prices out of control, could be another reason the economy slows down here. Is the Iran-Israel conflict. Iran's basically saying they're going to strike back. What's that going to mean? What could they do? One thing they could do is look at the Strait of Hormuz. Would threat or a partial closure, like what would that do to the oil prices? And yeah, I think that's something just to be aware of and to monitor from a trading perspective. Just obviously head on a swivel.
Well, all this plays into the fact, and this is the big story that we're going to talk about, is where the market has been up the last couple of months and volatility has been up. So we're going to cover that. But before we do, let's just get into our vol zone section here on what volatility is doing exactly today. And that will kind of lead us into our bigger story. So this is kind of going to be one big volatility show here that we have on tap. But when I'm looking at the skew index here, again, you continue to see, you saw this downtrend of put sellers, I guess you could say, that were more prevalent, call buyers through the back half of 23 and the first half of 2024. But recently, the put buyers have come back. They're buying puts at levels that we saw in 2022. So there's obviously concern not just amongst the Bezos and Buffetts of the world, but also the institutional players protecting on the downside.
Yeah, and it's no surprise, of course, yes, this is the trend we're going to be talking about, this decreasing volatility, which was snapped into increasing volatility. What happens next? But there's no question, into an election, volatility is on the higher end of the range. Let's take a look at what the skew did just before previous elections, Brian. We spiked in November in 2020, not surprisingly. Market kind of took that like event risk off the table, went sideways, and volatility came lower after that in 2016. Sorry, this was a big spike in volatility in 2016. And then a similar story to a smaller extent in 2020. We had a spike in volatility into the election. Volatility came off after the election into the new year. Should not be a huge surprise if that's what's going to happen. But I think what we're setting up here is this a new volatility regime, which is something different this time around. This is the VIX futures curve here, Brian. We have a really high spot VIX right now into the election. The VIX is sitting here right around 23, and the November future trading at a discount here right around 20.
Yeah, and I think, we always kind of look at this picture and say, what is the mean reversion? Where can it renormalize? And VIX probably lower towards the purple. The purple line is probably more towards the mean reversion that could occur. But when we have seen this sort of massive, what I like to call backwardation, where the VIX front month future and second month future are successively lower than each other, and they're lower than the spot VIX, I think this might be a good opportunity actually to own personally some VIX futures. We did that for clients. And trading at a discount to VIX, it's not a bad do, since that is such a steep discount right now.
Yeah, typically, of course, you see the future trading higher than the spot. So yes, that does make a lot of sense to me. It seems very opportunistic, maybe into the event risk to be looking at that. I think possibly a couple potential outcomes. Let's see, volatility does go even higher after the event. You could see this whole curve just shift higher, and we would still have something looks like that up here potentially. But as we're getting closer to the expiration, this gap here has to narrow.
I agree.
But and then after, I think into the new year again, we should be expecting this curve to go back to its normal shape, something that looks like that.
If a bear market is not coming, and when we've seen 1 or 2 month bear markets, we have seen this backwardation persist for a month or two. So it doesn't mean it's going to snap back right away, but if it sort of persists, it's probably an indication of a bear market going on.
Yeah, that's a great point. The longer we see this, the more likely it is to see some sort of big market correction, and then really, yeah, this gets thrown out the window. This curve. Looking at the S&P 500, we've been following this all year long. We've been in that higher trend line at the start of the year. We got sucked out of that trend line in the middle of the year in June, and we have not been able to really get back into this higher end of our upward channel. It's been resistance ever since then, and seems like we're kind of stuck in this purgatory of in between here.
Well, yeah, I'm a little worried that that formation is starting to see a little bit of a head and shoulders top, like on a shorter term picture formation that could shake down then below 5,500 and start to form a bigger sort of head and shoulders top. I think that's the real concern that I would be watching really is like this 57, call it 25 level, and then somewhere down to 5,500 as sort of support areas for this market. So I'd like to see the market continue to hold above those levels to be a buyer.
Yeah, and even more worrisome is the Nasdaq here. Of course, we had the S&P 500. Had this high here, July, made a new high. Nasdaq did not do that. We like to see the Nasdaq leading things to the upside, so maybe that is a worrying sign. We'll see also having a similar chart pattern like the head and shoulder pattern Brian had brought up in the S&P 500, and it's even more pronounced here, Brian, in the semiconductors.
Yeah, it is, and it's sometimes like these little patterns kind of like are self-fulfilling, but then it's a question of if there's a carpet shakeout, so to speak, and they reverse itself the other way. So, yeah, the fact that the semis haven't participated with everybody else is a little concerning, but maybe it's just that. I mean, the one bull, I guess, case towards it all is that NVIDIA is such the leader. They're taking over the index, and the other semiconductors are struggling to sort of keep up with the level of participation and order flow in terms of revenue that NVIDIA has done. And so there's like a discount separation between those two. So that could play part of the reason why SMH as a whole is sort of, underperforming.
Yeah, I mean, there was like this head and shoulders right here, which you got shook out of and then rallied right here. So, I mean, could we see another thing up here and have that shake out? We'll see, but yeah, it's something to watch. It's something that's still I am going to put a lot of weight on just being above this level for the rally to continue.
Yeah, and I'd be watching on the downside that 225 level on SMH as a indication that formation that you just drew out actually comes to fruition, and then there's a further breakdown, which would probably take SMH significantly lower.
Yeah, and finally, I traded this, Brian, last week, kind of a stock replacement, just kind of a way to get out of the stock into earnings, sold the downside put, bought an at-the-money call spread, was able to have a little bit less risk to the downside on this event. But you can see this Microsoft chart is the realization of that head and shoulders pattern, which we were concerned about here. So it does. Is it going to realize this pattern? Is it going to break down to like 350 or something? It's possible. It's possible. It's also possible for it to reverse and just go back to this higher end of the range here.
Yeah, I mean, Microsoft looks pretty dangerous chart to me. Break the 398 level, probably takes it down to 325, back to those lows in September of 2023. So that's something really again, another chart to sort of watch these technical breakdowns on support lines, because once some of these go, all of them are going to kind of follow suit together.
All right. So, Brian, let me take you back in history for our big story here for the day. This covers your early career on the floor. This VIX chart here. This is your time as a floor trader and then into your early days as a VIX trader in the VIX pit. Now, we know there was the dot-com correction, a recession in 2001, 2002, a lot of volatility. And then we saw a long period where the market rallied, recovered, and we saw a long period of declining volatility, right? But then something happened in 2007 here. We saw volatility woke up, and now we're in a new regime, right? We're in a new vol regime here for the rest of the year. And actually, surprisingly, we get this volatility pickup here, this spike above 30, and 2 months later, we have the market reach an all-time high, and then that is the all-time high for the next 2.5 years, and the market is 40% lower. So, I don't want to spook anybody out, but last 5 years, what have we had? We've had a nice recovery here. We've had this, of course, the COVID volatility spike, and then 3-4 years of volatility being compressed, right? And then we had a volatility spike, and that was about 2 months ago. And what do we have here 2 months later is we have an all-time high in the S&P 500. Is that going to parallel the 2007 volatility spike into the market going higher? Now, meanwhile, we have volatility settling into this higher regime, just like we did in 2007. Now, it's happened in other times too. If you think about 2022, and kind of like a little microcosm of we had a great 2020, 2021, and then the market went south in 2022. Well, we did get this big spike here in volatility, and of course, at the end of 2021 here in November, end of December. And of course, what did you get? Oh, a month later, you had the market reach the high. So, and then of course, and obviously that the other parallels, of course, you have this declining volatility breaking out. So what happens is over this period is you have market higher, volatility higher. So my question is, Brian, market higher, and the market's been higher since August. Volatility's been higher since August. Are we reaching the top in the market? Should we be saying, hey, the signs are there. Everyone's pulling their money out of the market. We should be cautious here.
Well, I mean, it's always been to me a warning sign in the past, and this data obviously backs that up. I think a lot of it also of market higher, volatility higher. Some of it is the election this week, Federal Reserve rate decision this week, although we kind of feel like it's going to be 25 basis points and that'll be it. But also some of that is the shift in the interest rate yield curve of the 10-year finally going back above the 2. And when we look at historical volatility on that sense, that's has typically led to greater volatility in the stock market when we've seen that yield curve shift back to normalization, because it takes them a little bit of time for the money to sort of start to recirculate. The reason why it's shifting now is the Fed's needing to cut rates because some of the economic data is not that strong. So a lot of these same characteristics are lining up for both on a technical volatility aspect historically, but also from a fundamental basis in the marketplace. That would leave me a little bit cautious about where I am, and I mean, not just maybe a little bit, but a lot of bit worried about what's to come.
Yeah, I mean, this is something we remember very well. Volatility higher, market higher in 2007. That was a warning sign. That was a sign that investors, volatility traders, are gearing up for some movements in the stock market. Now, most of the time, the stock market has a negative reaction to movement. Our movement is associated with the stocks going lower, especially when it comes to volatility, because we know volatility is insurance. You buy these options, but sometimes as insurance, and the more expensive the insurance premiums, the more risky something is. So the higher the premiums is, the riskier things are. The riskier the market is. Usually when volatility is going higher. There are other times though, Brian. There are times when we see the stock market going higher when we're breaking into a higher level of volatility regime. Now, this is another instance where we had a recession in the 90s, 91. Volatility was higher, and then we had this low level of volatility regime. We broke higher in volatility and then went up in this higher end regime here in 1995. Might ring a bell. The Fed also lowered interest rates in 95. So could that be something where we see, oh, wow, we got this higher market level when we're breaking higher in volatility? Anybody's guess is as good as mine, other than the fact that I will say it's going to come down to the economy. The economy needs to stay out of a recession. If it does stay out of a recession, then we got the Fed, adding to growth, and we're not necessarily slowing down in the first place.
Well, here's the thing. Like, I do think though, if you look at this chart in the S&P, right at the end of 95, right, you had that spike in volatility. Market moved to all-time highs to close out 95, but then it did sell off, and that was what I call a carpet shakeout, where it was like, who else is on board? You did have still a significant pullback off those highs. It's just that the market then all of a sudden reversed itself and then moved higher. So I think how do we play this? That probably leads into like our trade of the day of how I would play the S&P in all of these scenarios. I think maybe there's one way to sort of do it, because either way, the market's either significantly higher or significantly lower after this point, right, Joe?
Yeah, raise cash and
buy a call. So I'd be looking at the SPY strike here, the 580 call. It ends at the end of the year. Okay, it's a couple percent out of the money right now. I'd spend about $10.60, which is, it's a little bit pricey, right? Volatility's higher right now. We talked about it. VIX is up, so price premiums of options are a little higher. This call is going to cost about 2% of the value of the stock, and you're going to need it to move up through the call strike to pay off. But I need about a 4% move to the upside. But when I look at the amount of moves that happen off these sort of like toppy scenarios, 4% to me is nothing to give up. Like you said, I'd rather raise cash, own a call, only risk $10.60, so that if the rip is higher, I continue to participate. If the rip is lower, like an 07 scenario, I'm out of the market. Maybe if I start to get bullish and I say to myself, look, if the market is down 10%, I'd be willing to sell a put and get long the market again if we're down 10%. Although I don't know if I would do that just yet. I'd probably want to see the VIX get above 30 before I consider doing that. But that could be something where you can now start to trade around this call. It doesn't have to be bought and held, but I can start to trade around it, whether the market shifts to the downside very quickly. There's a volatility spike. I can sell a put, or the market races to the upside. I can then start to think about selling a call if I really want to.
Yeah, and I'm absolutely with you on board on this. Number one, we're taking their downside risk off the table. We know what we're risking here is 2%. It's not going to be 10% if we do have one of those big corrections here in the next 2 months. So that makes perfect sense to me. And I do like the idea of selling a put to make this upside cheaper. But you got time to do that. You don't have to do this right today. It could be a great opportunity to do so if there is a sell-off. If we do go lower, sell a put, because then you go down even 10% further. You'd be 20% from now, and you can still collect that money, make that call cheaper, or you could just or you could collect enough money to make the call completely paid for too, down lower. So yeah, I like stepping out, raising some cash, and buying the call. Now, if we had less conviction, or we're less bullish, had more of like a very certain feeling that the market was going to go lower, I would not want to own the call. I might just at this point say, hey, I just want to pick the level to buy the stock and sell the put there.
Yeah. So, I mean, this is a scenario. It's called stock replacement. It's because, we think that at this moment in time in the market, being long the market only, it carries some significant risk, whereas we're willing to just pay for premiums of options instead. And yes, volatility is a little bit elevated than normal, so these premiums cost a little bit more. But I think the volatility landscape has got it right, and I do think we're going to see a very significant move over the next 2 to 3 months. So be careful here, Joe.
Yeah. What if the hedging though is there? People have put their hedges in place, protection on ahead of the election, and then there's no more trading to do after that. Is that possible? Is there a contrarian side to that?
Well, I there is, because I think when you brought up one of those charts on the election cycle where the put skew or puts were in volatility was a little bit elevated ahead of the election, and then obviously you got the results, and then volatility came off, premiums went down. But again, if that happens, fine. I do think this call goes up in value. There's still some time. This is like 45 days out. It's not like something expiring tomorrow, so I don't need this to pay off right away. And then I'll be able to readjust, and we'll give an update next week, right, Joe? So that's why tune in every week, Mondays, 1 p.m. Eastern. This might be a good time to just kind of wrap the show up. What do you think, Joe?
All right, I'm with you.
So it's gonna be big. It's gonna be big. We'll tweet out throughout the week, or X out our posts on where we're at. If we make any sort of adjustments this week to this trade, but keep following us on Twitter at Brian Stutland or at Joe Tige. Follow us on YouTube as we post this video as well at Equity Armor. please tune in every week, Monday, 1 p.m. Eastern, the Trading Zone here, sponsored by the MIAX. I'm the Trader Your Hub. We look forward to seeing you next week with more to come.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.